Thank you. Mr. Marchant's recognized.
Thank you, Mr. Chairman. Mr. Vanderhei and Ms. Miller, you both state in your testimony that despite what some may claim, studies show that current tax incentives for savings for retirement are quite progressive. What would be the effect on progressivity if you lowered the top marginal rate to 25%?
That's a very complicated question and depends in part on what else you've done when you've lowered that marginal rate to 25%. I mean, it is a fact that as the top rate declines, there is less incentive for tax deferral because you're saving less money when you contribute. If that, but there are other competing ways to save. It depends in part on what's happening with capital gains and dividends. If you have no tax to be paid on an investment, as David would like to see generally, then it becomes very difficult to incentivize an employer to put in a plan unless you specifically have a targeted tax credit or some other specific benefit to encourage that employer to put in a plan. So I think that this is something that is particularly sensitive to what else is happening, and that but it is true that as the rate declines, the incentive, the cash that's freed up by putting in this plan also declines, and so you'll have to be careful not to give it a double hit, certainly, by also, maybe you need to increase the contribution limits in order to maintain an incentive there for employers to put in plans.
Thank you, Mr. Vanderhei.
Well, I agree with what Judy said, and I'd like to just amplify it a bit. We had done some work last summer looking more at the Simpson-Bowles type proposal, but I think a lot of that could be expanded to this type of proposal if you're reducing the marginal tax rates, especially for the small business owners. You're changing the calculus of what their cost-benefit analysis is of providing that to the employees. And Judy has in her written testimony a graph that we worked on last year that actually shows, I believe we had as much as an 11% decrease in the number of small plans defined as plans with less than 100 employees because of the 2020 limits. If that's something you would be interested in, we could very easily modify that to look at what the impact of decreasing marginal tax rate would be apart from the 2020 limits, and I could get back to you on that if you're interested.
I think we would be interested. That's in all of our proposals, that tax rate be capped to 25%. And for Mr. John, what would be the overall effect on retirement savings of adopting the 2020 proposal as was proposed by the Bowles Commission?
I am not a micro or macroeconomist, so I have not really modeled it. I usually tend to defer to Jack on issues along that line.
Okay. Well, Jack.
The 2020. Actually, we have a figure in the written testimony that takes a look at what would happen. I don't think, surprisingly, the biggest hit would be on the highest income quartile. We found, for example, that people currently 36 to 45, if it were applied today, would have about a 15% reduction on average in their retirement balances. What I think comes as a surprise to many, though, is that the second biggest hit actually comes on the lowest income quartile. And that's because of the 20%, not the 20,000. And one thing that many people ignore is that oftentimes people will come back into the workforce later on in their age. They may be a spouse, and they may find that because of catch-up or whatever, they have the ability to put much more of their income in. We find that they are the ones who typically end up triggering the 20% as opposed to the high income who trigger the 20,000. But even for what we found for 36 to 45, almost 10% for the lowest income quartile, 10% reduction in average account balances because of 2020.
I think that's actually understated for the lower paid because small business owners, they would have about zero incentive for putting a plan in, and the safe harbor contributions they make for rank and file workers would be gone. And so I think that really understates the negative impact.
Thank you, Mr. Chairman.